he was talking about, cards, and I was already into sports, so that's kind of like how I got into cards. Um, but I was into Gary Vee because of more motivational type stuff, and I listened to like Tony Robbins and Eric Thomas, like people like that. And um, I guess it's one of those things where, oh, I just lost my train of thought. Oh, I thought I was gonna make a good point, but oh yeah, now I remember now. Yeah, so I was listening to a take from Tony Robbins, and it was about finances. It was like after the financial crash, it was like 2012, something like that. And it's this economist who did a great job at predicting when there are going to be recessions and downturns in a sense. And he was, only like, I don't know, some months off or something of like when possibly we have a recession. He predicted 2023 because the baby boomers are going to be entering mass retirement by then. And then you have like the largest group in American history that basically have most of the wealth, if not all the wealth, entering retirement. So you go from like putting money into the system to taking money out of the system. And also that's including investments too. And they're going to try to get into the safest possible investments ever. And then like right before they enter retirement, they get into the most speculative stuff because they need as much money as possible
exactly right.
to retire. Which is also interesting. Why I'm thinking about some of the people who are selling some of the higher end sports cars, especially vintage stuff. Are they baby boomers or not? Because for a lot of them, it makes sense if you're planning on retiring. Like if you got $1 million car, you might want to sell it. Example would be, unfortunately, this guy died. But he was like a neurologist. And there's some big Babe Ruth cards. I think Mickey Mantle cards. It was like last year, I think that sold. It was like the total amount the family sold for, I don't know, $30 to $40 million. And he unfortunately passed away from COVID. But like that stuff hit the market because of that. But if let's say you're still alive, some people are gonna keep it for the rest of their life, and some people are gonna live a long time. But like, it's just one of those things where it's like, especially with this downturn, right? Like stocks crashed or whatever. Real estate may be slowing down. So it's like, oh, I'm planning on retiring the next couple of years. Let me maybe not sell all of them, but sell some of my top cards or whatever to help me into retirement. Since maybe if you bought stuff in the 70s or 80s or 90s or even early 2000s, it's like it's way more worth now. So you might as well just cash out. And I guess I was wondering like how many people maybe who are baby boomers saw stuff just go crazy, let's say 2021, and just decide to sell it. And maybe there was like a transfer from older people to younger people in a sense.
Yeah, you make a really interesting point about the year 2023. And I don't know if you've heard of Elliott wave theory. They use sentiment in terms of technical analysis they use waves. And these guys that I follow, one of them is Avi Gilbert. And there's, I think, Robert Prechter too, but I follow Avi Gilbert. And he's talking about 2023 to 2024. He's seeing something on the technical side. And he hires fundamental guys, technical guys, etc. But he uses his opinion and, he has other strategists as well. And he's come to a conclusion, 2023, 2024, you're going to see, he says, potentially a 1 to 2 decade bear market. And it could coincide with what you're saying, baby boomers, right?
Yeah.
And retiring. And I'm also looking at this one guy, Martin Armstrong. And I know some people say that, hey, when you say Martin Armstrong, people say, oh, he went to jail. Okay, yeah, sure, he did. But I always say that before I make this argument. And he looks at something that's really strange. It's the cycle of pi. And every 8.6 years, you tend to have something like going wrong. And it looks at different markets. And his conclusion is that, or not conclusion, part of his analysis, he sees something in 2024 as well. And I'm just looking at, okay, you're talking about, okay, baby boomers retiring. This one guy says recession 2023. So this latest pullback we see in the stock market and crypto and cards. So if you have a little bit of run up the next 1-2 years, some of these baby boomers, in my opinion, they're going to be like, I got to get out. I'm
Mm-hmm.
retiring. And I think that's when I'm going to probably be cashing out just to be on the safe side. And then, if the cycle is aligned, you buy low and you sell high. And that's what I'm still expecting. I mean, I
Mm-hmm.
could be wrong. I mean, I still have money, in the retirement fund, but these are just my long-term thoughts. I mean, you can't accurately predict the future, but you could have a sense of, okay, you buy when it's fearful, like a couple of months ago for me, that's the time to be buying. And
Mm-hmm.
then when everyone's excited, remember February, March of 2021, everyone thought they were an expert. Everyone was jumping down with the sausage tea sale. I'm not bashing on anyone, but like people were excited, right? People were excited about Fleer 86. Everyone thought that cards would just perpetually double. And no, that's not how markets work. So you just got to use sentiment. And if everyone's on one side of the trade, you got to ask yourself, are these guys just being fooled just by what's going on? And you just do the opposite. Just be a contrarian.
Yeah, I do think there's one more thing that goes my mind that's like affecting well, there's two things. One, globalization seems to be ending slowly but surely. Um and that's going to have a large effect on things. And that may be part of the inflation issue, where I look at things like productivity versus not as much productivity. So maybe one way of like improving the economy is improving productivity. So I think a lot of factories, you know, are going to go other places outside of one because it's getting more expensive for China to produce stuff because a lot of people are starting to not want to take those jobs. So they're trying to outsource to other places. Except Apple. For whatever reason, Apple wants to double down in China. But a lot of there's starting to be certain things like going back to United States and then also Mexico as well. So more production going closer to home. It may open up more jobs in a sense. I don't know how much that's going to affect immigration and what kind of workers that are going to come to the United States and compete with jobs and all that other stuff. But that's a factor. The other one is technology. I look at it. The biggest technology that kind of like moved the economy forward is the microchip. You have it in cell phones, have it in computers, and then there's a lot of stuff that's based off those technologies or systems or platforms that the microchip uses that created jobs, created productivity, has made life easier. It seems like, at least from afar, because I'm not really in the tech world, but it seems like that stuff is starting to slow down. Like you buy an iPhone or a phone, is not that much better. The computers don't seem to be like that much better now. Even some of the smart technology type of stuff, it seems like it's been around for a while, and a lot of that stuff isn't improving the way it used to be. So it might be a scramble for people looking for the next big technology to kind of like push the economy forward and have a massive uptick on jobs, productivity, and just solving problems in a sense. I think people think NFTs and crypto and stuff, and that's also that like the world is kind of struggling with as far as like improving the economy and having more money in the system so people can invest and put it to other things such as sports cars and collectibles. But also, from a way I look at it, normally what happens for a lot of collectibles is stuff normally goes well in traditional markets first, and then those people take some of that money out and want to diversify and then put it in those collectibles. And I don't see a lot of this stuff as far as cards, even comics, even video games, especially pop culture type stuff, doesn't seem as productive. It's almost like you're sloshing money around. What most people are doing, they're buying cars or buying a comic book or something, and they're holding it, and they're going to sell it at a higher price. Even certain cryptocurrencies are like this, and it's like not even. I don't see the use in a sense. So I wonder like how this is going to affect the market. So I'm throwing a lot of stuff at you.
Yeah. So the way that I've looked at the collectibles market, and I've delved into precious metals to trade it, and I've made many mistakes. I've lost money in it, but through that loss of money, I've learned a few, I think, important details about precious metals and collectibles. And I know it's not going to delve into what you just stated, but for these collectibles, what I've noticed, and also with precious metals, they tend to do well in a negative interest rate environment. I know it may be a little bit over the head of some of the people that are listening, but I look at the treasury inflation protected securities. If that yield is negative, you tend to see collectibles doing well. If you tend to see the treasury inflected, if you see the tips yield positive, that's when the prices are usually correcting. So in terms of productivity improvements and what you're just talking about in efficiencies in the economy, that is great for an economy, but I don't look at that to determine, okay, our collectibles going to go up because of efficiencies in the economy? I'm looking at it from what sophisticated money is probably doing. And I've looked at data from the 1970s. 1970s collectibles did pretty well. And they corrected in an environment when the economy was actually booming under Reagan. I think the boom started 1982, and collectibles. I mean, sure, people bought collectibles, but they didn't yield that high return. The return came when I think it was from 87, after the crash of 87 to about 1994. So what happened was they were lowering interest rates from 87 because of the crash, and you had the S&L crisis. And then what happened was, at the same time, you had people that are slightly older than me. They were young and they had their parents buy them cards at stores. And then people a little older than that, in their 50s and 60s, they just started speculating in sports cards as an investment. And then if you look at 1994, the bond market crashed. The bond market crashed because the Federal Reserve was aggressively raising interest rates, and you had positive interest rate environment. So you had a negative interest rate environment where it boomed, positive interest rate environment where collectibles didn't do so hot. And then you had a correction where, okay, you were raising interest rates to about 2020 or 2000, and tech boom happened, and then everything came tumbling down. So long story short, collectibles, in my opinion, if you look at a normal environment, right? What I'm trying to say is, in an inflationary environment, they tend to do well. They didn't do well this time around because we were in a pandemic. Okay, so that was a whole different story. And everything came tumbling down aggressively when the Fed started raising rates. That was one aspect, and then the economy started to open up last year. That was the first fall, and the second fall was the Fed this year, in my opinion.
One thing, there may be a little bit of a pushback on that theory, just because after the sports card market crashed, a lot of people, I believe, got into toys, and Beanie Babies was kind of like a thing in the mid to late 90s for a while. So that was like a weird thing as well. Obviously, Beanie Babies are non. That's I'm assuming certain things, maybe like MetaZoo, some of this really speculative stuff, card stuff, is probably going to go the way of Beanie Babies. Just because I don't see a reason why people want it outside of it's going up in price. but I think I heard of that, comics, and there are a few other things that kind of came out of nowhere. Like Pokemon was huge from 1999 to 2021. And I think comic books had like a crash in like around 99. A lot of stuff, Beanie Babies comics, a lot of other stuff like crashed around 1999. And I don't think,
99, 2000, right?
yeah,
2000, yeah.
yeah, I don't think it had much necessarily to do with like the .com bubble. Maybe a little bit because maybe some people were like in both, but it seemed like it may have been like its own thing.